This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We now move on from having dealt with non-savings income within the framework of the income tax computation to deal with savings income. Now, we already know a lot about savings income, and the first few parts of these notes are basically a review of what we already know. We know it's interest income here. We know that it is, again, well, maybe you didn't know that, but it is received gross without any deduction of tax at source. So unlike as seen in the last example, employment income will always have suffered tax at source, with the employer deducting that tax at source under the PAYE system. There's no such equivalent. It's there in the notes making that point because years ago, banks also used to deduct income tax at source on interest. That does not now happen in the vast majority of cases, and certainly in all of the cases that you see within your taxation syllabus. So it's received gross, that is the figure you include within the computation. What does it include? Interest from banks, the main one, building societies, again, financial institutions, as we said earlier. They were originally set up to lend money for the purchase of property, hence building societies there, but now they are routine financial institutions and have a lot of other issues that they deal with. Government security interest and from corporate bonds, again your loan interest, your debenture interest. What we also saw, of course, noted in 1.1 above, is that there are some exempt sources of interest, and there again there are usually inclusion. Again, as we've suggested, a 2-mark section AOT question might ask you to work out what is the amount of savings income that would be chargeable to tax for a tax year, and what they do is to mix it up with different types of interest there, which has the various types of taxable and also 1 or 2 of the different sources of exempt income in there as well. The basis of assessment, i.e. how do we relate this source of income to the tax year in which it will be assessed, for us the 2019-20 tax year, it is, as in fact we saw with employment income, and it's applicable to all our sources of income other than trading income. It's very simple. We work on a received basis. Received here in terms of interest is, of course, like with a bank or building society, when that interest is credited to your bank account or to your building society account. We know that. The calculation of tax on savings income. We know that taxable interest received is included as savings income. It goes into the savings income column within your computation as well as part of your total. Any deductions that we've made in the income tax computation. Now, that's a bit of a wavy line, isn't it? Those are your personal allowance and before that various reliefs, like the qualifying loan interest, whatever that might be, and various trading loss reliefs. Those deductions are made again on the income tax computation, and again, as we've said, for purposes of this exam, they are deducted firstly from non-savings income, then savings income, finally dividend income. And that's the reason, of course, why we have the order in which the analysis columns are listed. As you look at it on your page there, you go through from non-savings to dividend, and you derive at the end of that your total income figure. Non-savings income, as we have seen and will be applicable throughout, is always the first slice of taxable income to be taxed. Followed by, so again, you're moving across your analysis columns. Your analysis column has given you your figure of taxable non-savings income. You tax it in your tax calculation. You then move to the savings income. And when necessary, it won't be in our first few examples here, but we then move on to dividend income. And the total of all those figures of tax will be the tax liability. As we saw with example 1, if there is employment income, then tax would have been suffered at source under PAYE. They'll only give you that PAYE figure if there is a reason to compute tax payable. Now, okay, in an objective testing question, they could very well give you the amount of PAYE, but still ask you for income tax liability. So the PAYE is irrelevant. But if they are asking you to compute the tax payable, then they must give you the amount of PAYE. You cannot compute tax payable without that figure. We also know that we have basic rate, higher rate and additional rate, and we know the bands. We have a basic rate, there you go, basic rate band limit of 37,500, go above 37.5 and then up to £150,000 is higher rate, and that is indeed the much higher rate of 40%, and any taxable income above £150,000, that's in the additional rate band, and that is 45%. So that is all stuff that we already know. So what is it that we now need to add to that fund of knowledge to be able to deal within an income tax computation, or separately within an individual objective testing question, the taxation of savings income? I said to you at the end of the last session that this was going to be a little bit more interesting than all we had to do with non-savings income. And that we see now. The taxation of savings income, again, if you'll pardon the pun, is more interesting due to the introduction of something called a Nil Rate Band. That Nil Rate Band, notice a rate band. That is a rate of tax. It happens to be nil. This is not an exemption from taxation. It is a rate of tax to be included within your income tax computation. As part of your tax liability, you show this. It will use up, as we'll see, a part of your basic rate band before moving towards higher rate. You must put it into your tax calculation, albeit it is at a nil rate. How much is it? Well, £1,000 to begin with, but that's only if you're a basic rate taxpayer. You're only a basic rate taxpayer if your total taxable income does not exceed the basic rate band limit. There for us at the moment, £37,500 there. If you are a higher rate taxpayer, then you'd have been entitled to £500 worth of nil rate band on your savings income. Sadly, the poor, I say the poor old additional rate taxpayers, a bit of a misnomer, isn't it? I don't think we're too poor if we've got taxable income in excess of £150,000. But additional tax rate payers, they do not benefit there. There's no savings income nil rate band. As we just made the point, this savings income nil rate band is a part of your tax calculation. So therefore, that either £1,000 or £500 counts towards your basic rate and higher rate thresholds and limits there. It is included within the tax calculation. We'll see that with the examples that follow very soon. Now, that's one new interesting element to the taxation of savings income, the awareness of the application of the relevant, if any, their savings income nil rate band. And before that came in just a few years ago, we had, and it therefore now supplements, what is again a 0%, a nil rate, but we'll call it a 0% starting rate band. A starting rate of tax that is, however, only available to taxable savings income that falls within the first £5,000 of total taxable income. Of total taxable income there. Savings income is taxed using the same rates as non-savings income listed above, but to come back to this, the starting rate of tax of 0% will apply to a maximum £5,000 of your taxable savings income, where, and this is the critical issue that often game students have a problem with, it's only applicable where any part of the taxable savings income falls within the first £5,000 of total taxable income. What does that mean? It means that if the first 5,000 of taxable income, remember, which source of income do we tax first before savings income? Non-savings income. That is taxed first. So if the first 5,000 of taxable income consists of non-savings income, if it's all filled up, the first 5,000 of taxable income is all non-savings income, then the 0% rate will not apply. So we know we've got a personal allowance of £12,500. If therefore our non-savings income was £12,500 or less, then it means that once you've used up your personal allowance, any of your savings income would be then firstly using up the first £5,000 of your nil rate band there applicable to savings income. So if the figure of non-savings income is £12,500 or less, you have a full £5,000 starting rate band to enjoy against your taxable savings income. If, however, your, for example, non-savings taxable income was £15,000, if it was £15,000, your non-savings income, if it was £15,000, the personal allowance to deduct from that £15,000 would bring you down to taxable non-savings income. 15 minus £12,500 would be £2,500. That £2,500 would then be taxed at 20%. It's in the basic rate band. But then any of your, if you had up to £2,500 of your savings income, that then would enjoy the remainder of the starting rate band. So 15,000 non-savings income, take away your personal allowance 12.5, taxable non-savings income 2,500. So of the first £5,000 of total taxable income, of the first £5,000 of total taxable income, you would have 2,500 of that used up by the non-savings income. So that would leave only a possible maximum £2,500 of starting rate band to use against any savings income that was now to be taxed. Now again, don't worry, discussing it is always more difficult than actually dealing with it. I'll take you through the examples and illustrate all of that in a moment's time. Just one other issue, we've seen now two nil rates, the nil rate band, the 1,000 for basic rate taxpayers, the 500 for higher rate taxpayers, and we've seen a 0% starting rate band going up to a maximum possible £5,000 worth of that 0% starting rate band. Well, if that's two rates there, two 0% nil rates applicable, which one do we use first? So, if applicable, the starting rate is applied first to your taxable part of your savings income, followed by the savings income nil rate band, if available. And after that, you then go to your normal rates. So the normal rates, i.e. of non-savings income, the normal rates would then apply. So that is on top of, again, we know that we have those non-savings rate with a 37.5 basic rate band limit, £150,000 higher rate band limit. And savings income, as we noted before, is going to use the same tax rates as non-savings. But what makes it, as we said, more interesting is these two 0% nil rates, the starting rate band, as we have just seen, of 0%. We've got our starting rate band here of £5,000, and also the savings income nil rate band as well. If we have both, starting rate takes priority, then we use the savings income nil rate band. Right, to illustrate that now, leave alone the dividend income for a moment. Let's have a little look at example 2, where we had Billy had, now again in a question, what do we look at first? The requirement. Obviously here, income tax liability for our tax year. Then what type of income do we have? Trading profit of 27,500. What type of income is that? That is non-savings. We identify that on our question. And received bank deposit interest of 10,000. Bank deposit interest, that is savings income. And that is what happened in 1920, the tax year for which we now need to compute the income tax liability. So what I want you to do here for a moment, if you pause this in just a second, is to set up your pro forma income tax computation as is relevant. Now, what is relevant? We have identified non-savings and savings income. No dividend income, so you don't need a dividend income column. So set up your income tax computation with columns across the top, going in order, non-savings, savings, and then total. List down your income, earned income first, trading profit, followed by your unearned, your investment income, bank deposit interest, your interest income, and that is savings income. So your trading profit will go into your non-savings column, and also, of course, everything then goes into the total column. Your bank deposit interest, that will go into your savings income column, into your total. Total each column, well, fairly obviously, 27,500 of non-savings, £10,000 worth there of savings income. Put those onto your computation, get your analysis columns, but that, of course, is the figure of total income. We know that we've got to calculate income tax liability, so we need to work, therefore, through to taxable income. There are no specific deductions in this example from total income to bring you down to net income, i.e. qualifying loan interest and those other trading loss reliefs. So here, as so often it is, total income and net income are one and the same. But from net income, we are always looking to deduct the personal allowance. So we will have the full personal allowance of 12,500. What do you deduct it from? Obviously in the total column, but specifically in your analysis columns from non-savings before savings. The non-savings income is 27,500. Your personal allowance, 12,500. Therefore, the non-savings income will absorb all of that personal allowance. Therefore, get your taxable income figures analysed by non-savings and savings, as well as total. What we'll then do, now you can attempt to do this yourself if you so choose, but what we'll then do, once you pause this and you've got to taxable income, fine, have a go at it if you feel confident enough to do so and try to calculate then what the income tax liability will be. But I'll pick it up again from that point and take you through the calculation of the income tax liability. So if you pause there for one moment, then we'll come back and look at how you fared on getting the taxable income figures here in example 2. Okay, let's see what you have therefore, and hopefully your computation looks pretty much the same as what I have got there. We have our analysis on our total columns. We've allocated the trading income to non-savings, the bank deposit interest to savings income, and we deducted the personal allowance in order, firstly from non-savings income. The non-savings income is more than big enough to absorb all of the personal allowance. And what it's left us with is taxable non-savings income of 15,000. It, of course, then is the first figure of taxable income to be taxed. What is important about that is, when you're doing a computation of this nature, we analyse to begin with the sources of income. There on the question page, we put NS, non-savings, and S for savings. And as soon as you see that there is savings income, there is interest income, you have to start thinking about the applicability of the 0% starting rate band and or the savings income nil rate band. So what does this tell us? This tells us here at this point, when you have £15,000 of non-savings income, £10,000 of, this is taxable income of course I should say, £25,000 total taxable income. It tells you that 25,000, that is less than the basic rate band limit of 37,500. You are therefore a basic rate taxpayer, only a basic rate taxpayer. A basic rate taxpayer with savings income. Therefore, a savings income nil rate band of how much for a basic rate taxpayer? £1,000 is available to a basic rate taxpayer. So you know that. But before you apply a savings income nil rate band, if applicable to savings income, you would look to see whether any of the £5,000 0% starting rate band is available. And that's when you need that figure. The taxable non-savings income is bigger than £5,000. All of the first £5,000 of taxable income is non-savings income. What does it mean? It means there is no 0% starting rate band to apply to your savings income. You only get that or any part of that £5,000 starting rate band if the figure that you had there, the taxable part of your non-savings income, if that figure is less than £5,000. It isn't. It is of course there 15,000, and that means no 0% starting rate. So once from our analysis we've made those determinations, it's then hopefully a simple process of computing the tax. First, non-savings. How much? 15,000. We know all of that is in the basic rate band, 20%. So all being well equals £3,000. That's the first 15,000. We now move to savings income. We have already determined that there is no 0% starting rate band to apply. Why? Because that figure of taxable non-savings income has exceeded £5,000. No starting rate band available. But what is available is the savings income nil rate band. The only time there won't be any savings income nil rate band is if you're what level of taxpayer? I hope I hear you saying there, additional rate. But if you're basic rate or higher rate, there is a savings income nil rate band available. But it's different. If you are, as here, a basic rate taxpayer, it's as good as it gets. £1,000 worth of savings income nil rate band. Had we been, hold that thought, you will in a few minutes' time be, had we been a higher rate taxpayer, based on your taxable income being greater than the basic rate band limit of 37.5, then of course that savings income nil rate band would have dropped down to £500. But here we get the full 1,000, the nil rate band there. That's one out of the £10,000 of taxable savings income. The remaining 9,000, we are still within the overall basic rate band limit of 37.5. Remember, that savings income nil rate band there counts towards your basic rate band limit. So we've got 15 plus 1 is 16. The next 9 taking you to 25, your total taxable income, is all within the basic rate band. And you then use the same rates as are applicable to your non-savings income. They're 20%. If the figure had been bigger and we'd gone up into higher rate, then we would be talking about a 40% rate to apply. As we've already said, we determined very quickly that Billy was a basic rate taxpayer. That meant that his savings income nil rate band would be £1,000. Then, because of the level of non-savings taxable income, the 0% starting rate for savings income is not applicable. Why? Because non-savings taxable income, 15,000, exceeds £5,000. Now again, we can see that life is starting in the tax calculation aspect anyway, starting to get a little bit more difficult. But life will be a whole lot easier for you in getting your numbers if you use the analysis columns. So you know before you start to calculate the tax figure what is the taxable non-savings, the taxable savings, and where relevant the taxable dividend income. Although it takes a little bit longer, and it may not always be necessary to do the analysis columns as well as the total, if you've got a more complex situation with two or more different types of income, non-savings, savings, and also maybe dividend, I'd always recommend that you bother to do those analysis columns. Otherwise, when it comes to do your tax calculations, it could get just a little bit trickier for you. And if you're doing a Section A objective testing question, remember, it's no good investing 2 minutes in a question and getting it wrong, whereas if you invested 2.5 or 3 minutes in that question, it would give you full 2 marks. Remember, it's 0 or it's everything. It's all or nothing in those objective testing questions. Take time, get it right. There's a guaranteed 2 marks. Okay, that therefore was example 2. We now look to example 3. We're going back to dealing with Billy here, but we're changing one number in a way that I hope as soon as you see it and you put it together with the other information, you'll be able to identify what the issues are. We've got to recalculate Billy's income tax liability. But now we're going to assume that the bank deposit interest, his savings income, is now £25,000. So remember what that meant. He's got a trading profit of 27.5. We've now got our savings income of 25. Add those two numbers together, 25 and 27.5. That'll take us up to, what's that, 52,500. 52,500. Take away your personal allowance of 12,500. What will that bring you to? 52.5 less 12.5 is 40. 40 as your taxable income is more than 37,500, your basic rate band limit. So you're now able to identify that this time the taxpayer is a higher rate taxpayer. Again, what I'd like you to do is to at least here do your calculation of taxable income, analyse non-savings, savings as well as total. You may then feel confident enough to continue on and do your tax calculations. If you can, do it. Obviously, once you've attempted it and said that's as much as I can do, I'll go through it with you, so don't worry. But if you can get it at this stage, that's going to help you hugely rather than just watching me do it. So what does it mean? We know we got the 27.5. We know the personal allowance goes firstly against it within your overall total. We know that that left you with £15,000 of taxable non-savings income. What did that mean? It meant there was no 0% starting rate band to apply against your savings income. What it now also means, given that the savings income has gone up to 25, you become a higher rate taxpayer. The next issue as regards the taxability of your savings income comes into play. We've eliminated any possibility of 0% starting rate, but we've always got to consider savings income nil rate. What level of taxpayer is Billy this time? Higher rate. What does that therefore mean? It means that the first £500 of the savings taxable income is to be taxed at the savings income nil rate. That then will leave you with the remaining part of that taxable savings income that will take you through the remainder of the basic rate band, where we know we therefore use the normal non-savings rate of 20%. But then some of that taxable savings income just a little bit of it is going to be up in the higher rate. And that part is therefore to be taxed at 40%. Okay, have a go at least to get taxable income, and then if you can, go on and do your calculation of the tax liability. You can check that out in the back with the answers if you want to before I pick it up again. But obviously I'll talk you through that answer in just a little while. So pause now, have a go, and I'll see you again in a few minutes' time. Okay, well, let's see how you got on, therefore, as we now look at the answer to example 3. Now, I hope that there were no problems in deriving your figures of taxable income, whereby we allocated the personal allowance as ever, firstly to non-savings income. It, as usual, but not as always, has used up all of the personal allowance, and we get taxable non-savings income of 15,000. Savings income, 25, total taxable income, 40,000. Basic rate band limit, we know, £37,500, and therefore we're a higher rate taxpayer. As we've written here, Billy is a higher rate taxpayer, and therefore, oops, that's a bit hazy, isn't it? As an income nil rate band of £500. So that's the first thing sorted, the savings income nil rate band, because he's a higher rate taxpayer. But the same as previously, the first £15,000 of taxable income is non-savings income. That is more than 5,000. Therefore, the amount of 0% starting rate for savings income is 0. It's not applicable, as non-savings taxable income, 15,000, again exceeds £5,000. Right. How do we then show the calculation? Non-savings, 15,000 at 20%, same as before, equal 3,000. No 0% starting rate, but we do have the savings income nil rate band of 500. Not this time 1,000, our hero is a higher rate taxpayer. Remember that we had overall taxable income of 40,000. The first 15,000 was non-savings. Savings income is the next 25, of which the first 500 is at 0%. So at that point, we have got £15,500 of taxable income, albeit that 500 is at a nil rate. But we are deemed to have used 15,500 of your normal basic rate band limit of 37,500. So 37,500 less what we've used already, 15,500, will therefore leave us with £22,000 of remaining basic rate band, which we then proceed to use the relevant basic rate band of 20% in calculating, of course, the amount of tax on that taxable savings income. We've now gone above 37.5 into higher rate. It is £2,500 worth of taxable savings income within the higher rate band, and that therefore is 40% charge to taxation. Calculate your individual figures of tax. Do check the numbers, make sure that we got the right figure, but hopefully that comes to a total tax liability of 8,400. Again, look through these notes here at what we have said. Higher rate taxpayer, savings income nil rate band is £500, and that 500 there, as we've seen, counts towards the basic rate threshold, the basic rate limit, I should say there, of £37,500, leaving just 22,000 of basic rate band remaining to be taxed at 20%. It pushes 2,500 of your savings income into the higher rate band, where it's taxed at 40%. Now, of course, those bands, those rates and allowances will be unfamiliar to us at this point in time. But again, I hope that you are using, as I said earlier for you to do, copy off your page of rates and allowances and have that available as we work through this chapter. Because here are your basic, higher and additional rates. We've got what we call normal rates that apply, subject to what we've just said about savings income, to both non-savings and savings income. What we have not yet seen, but we'll see during our next lecture, is the dividend income tax rates that apply. What you're also told on your rates and allowances is the savings income nil rate bands, 1,000 for the basic rate taxpayer, 500 for a higher rate taxpayer. Now again, by the time you come to the exam, I don't think you'll be needing to look up this information at all. But at the moment, you don't think, oh, what was that? What do I do? You've got it there. Use that. It's a comfort blanket for you to use. If you have to use it in the exam, great, you use it. The chances are by that time, you've thrown away the comfort blanket. At least in this respect, you don't need it. We've got our basic rate band limits, 37,500. The higher rate band limit, 150,000. We know what our tax rates are within those bands. We've not yet seen dividend. We're also told the starting rate of 0% applies to taxable savings income, but only where it falls within the first 5,000 of taxable income. You don't yet know about dividend income or its nil rate band. You're told here, of course, the level of personal allowance. Okay, so all that information provided to you, remember to keep that page open. Going back, therefore, to our examples, there is now example 4. So what's happening here? The only income of Molly receives bank interest of 22,500, no other income. All her income is savings income. There is no non-savings income. Now you think, in the context of what we were just talking about, as regards the savings income nil rate band, and very specifically here, something that hasn't been an issue up until now in terms of its application, is the 0% starting rate band. And you see whether you can figure that out. Obviously, the calculation of the taxable income is not difficult. The analysis is not difficult. You have savings income, 22,500. To get taxable income, you have a personal allowance. It is 12.5. Your taxable income, 22,500 minus 12.5, is of course going to be £10,000. And that 10,000 is entirely savings income. Right, have a go at example 4 therefore. Please pause at this point, and then when you've had your go, again come back and I'll talk you through the answer, if that indeed is even necessary for you to listen to. Okay, pause then now. Okay, well, to quickly finish off this example and indeed this particular lecture, we know what we face with Molly. We've only got savings income. It's 22.5. All the personal allowance goes against it. The taxable income in total is 10,000. It's all savings income. Our taxpayer is clearly only a basic rate taxpayer, and therefore, as it says there, has a savings income nil rate band of 1,000. But what is now important is that the 0% starting rate band is applicable. And here is applicable in full. All of the first 5,000 of taxable income, there is 10,000 in total. All of the first 5,000, indeed all of the 10,000, is savings income. No part of that first £5,000 of taxable income is non-savings income. So we have got, and it applies first. Look back in your notes to see the order here. The starting rate band applies first, where it is applicable. It is only applicable where the non-savings taxable income is less than £5,000. Here there is none, so the whole 5,000 starting rate band is available. We then use the relevant savings income nil rate band. Molly is a basic rate taxpayer, so it's £1,000. That's accounted for the first 6 of the £10,000 of taxable savings income, leaving a balance of 4, all of which is in the basic rate. It therefore is charged at 20%. Income tax liability, all being well, £800. Right, read through those notes, look at what we've done. Hopefully there we've understood what those issues are, and we've now seen our first use of that 0% starting rate band. If I just take you back to, there's just one final example for you to have a go at. I want you to do this example 5 between now and next time, and at the beginning of next session, should it be relevant to you, I will review through that. What you now see is that we do have both non-savings income, trading profit, 13,500 assessable in 1920, and our savings income, this time bank interest of 18,000, and of course the income tax liability for Polly needs to be computed for this tax year. So, trading profit, non-savings, bank interest, savings, 13,500. We would allocate our personal allowance to that first of all. What would that mean? That clearly 13.5 plus 18 less 12.5 means Polly is a basic rate taxpayer. But this calculation is critical because 13,500 less the 12,500 personal allowance means that the first part of your taxable income is non-savings income, but there's only £1,000 of non-savings taxable income. Therefore, not all of the first 5,000 is filled up with non-savings income. It means there's still, therefore, a possible £4,000 of available starting rate band to go against your taxable savings income. That said, you have a go at that. I'll quickly review it at the start of the next session. And of course, thereafter, what we'll be looking at, having dealt with the complicated one, which is savings income, will then bring dividend income into play, see how to deal with it, but it not just in isolation, but it's going to be tested with you in conjunction with the other parts of the computation, i.e. non-savings, savings, and then dividend income. All that and more next time.